Hey everyone, it's Mikey Millions here, and we are finally going to kick off episode 9 of the Robinhood 3K Challenge. It's been over a month since my last 3K Challenge post. People have asked, is Mikey dead? Did he blow up his account and that's why he didn't post? No, neither of those happened. If I die, it's actually in my will that someone tell you guys, and you know me, I can't blow up my account because I don't put my whole account at risk, although Robinhood seemed to be pushing me in that direction. As you might guess by the steel pouring down my back, I felt the heat this week. We'll get to that. But it did take me a while to upload, and my initial problem was that I had just got done moving and had my hands full. Just to give you some perspective, this is what my studio looked like. We had an Amazon box mousepad, some shirts for soundproofing, charging cable under the door. It looked more like a 4chan FAP dungeon. It worked for a little while, but about halfway through making this episode, my hardware just died. I don't know if it overheated, it got coronavirus, or it just didn't like the new house, but I was dead in the water for weeks until my new hero, Scotty the Dragon, came through and sent me an entire new computer, plussed up with some more hardware so I could get back on my feet. It is thanks to this new machine that I can continue making this video. But because of that heavy delay, this video is going to feel a little outdated. Because it is. But we can't make the season 1 finale without an episode 9 first. So let's get cracking. And I'm sure everyone wants to talk about coronavirus and the crash that's setting us back to 2016 prices, and we will. But we're also going to explore such important concepts as the post-earnings spread and the PP touch. The stock crash is fun, but we're more than call and put buyers. Coronavirus will pass, but the PP touch will live on. So let's get educated and learn how to use it. And last thing before kickoff, I want to thank the OGs, Tyler, Evan, Andrew, Dustin, Deleted, Happy Purple, Natachka, Matt, Uncle, and Destonio. And the crowd lancers of House Theta, Aurora, Dragon, Rock, Sack, James, Dreams, Peter, Paul, Rommel, Someone, Kobe, Pete, Zach, Party, Devin, David, Assassin Joe, Jared, David, Hare, Joseph, Jonathan, Guy, and Will, and Cole. This sausage fest of OGs and Lancers, plus about 30 henchmen, are on board contributing to Patreon and rolling covered calls in the trap house. I want to give you guys a personal thank you for the support, and with that said, let's get rolling into the challenge. To recap what we've got so far, we've been at this for 8 episodes to date, 7 of which saw gains of various sizes, and 1 saw a loss. We heavily utilized the wheel strategy in the first 4 weeks, grabbed gains of $259.44, and then we switched over to spreads for 3 episodes, and made just $61.19. In episode 8, we started using both spreads and the wheel at the same time, and we're going to continue doing that going forward. As an additional note, I used the premium from the previous weeks to buy a share of Triple Q at $234.49. It was probably the worst time ever to buy tech, but we'll talk about that in a little bit. Here's our approach to episode 9. We are starting with an account balance of $3,381.74, a gain of 12.7% from our starting point. We're looking to end this episode above the $3,500 ceiling. That is a 3.5% gain from our current balance, and that would put us at a 16.6% gain overall. Let's do our best to get there. Here's how we'll do it. We've got quite a few plays to get through, but let's start with the Democratic vote. In episode 7, Eric Shusted nominated GameStop for my episode 9 trade. The crowd was very concerned, and the nomination didn't get much traction at first. Robert Papageorge's nomination of Tesla took a quick lead, and that would have been a dick-slapping good time, but by the time I tallied the votes, Eric's GameStop nomination was the clear winner, so let's check out the technicals. Beginning with GameStop's RSI, we dropped below the 50 mark 2 weeks ago, a drop that is confirmed by price action, and the RSI has since trended lower. This is obviously a bearish indicator. For the moving averages, we are below both the 50 and 200 day, so that indicates a bearish trend. Price action and candlesticks show a big drop here yesterday, and when we see that, we want to see if this gap is likely to recover or if there was some actual bad news that caused this drop. A quick Google search shows that GameStop straight up suffered a 27.5% decrease in sales last holiday season. The CEO says it's because people are waiting for PS5. We know that's a lie. GameStop is just dying. I don't think this gap is filling anytime soon, so this is a strong bearish indicator. And finally, MACD, my favorite indicator, is showing that we just suffered a bearish crossover and selling pressure is on, so that's also bearish. Basically, there is nothing positive going on for this company or its technicals. I mean, it's GameStop, it's going down. It's a brick and mortar store in a digital environment, and it's not going to be that high flyer we knew and loved in 2007 when Call of Duty Modern Warfare was all the rage. Soap McTavish isn't saving the day this time. GameStop will die this decade. But one thing we can say about GameStop's technicals is that I don't think there's much more room for it to drop. We're in penny stock territory, so technicals mean less than normal in this range. Based on this chart, I think we're going to see some support at the 450 level where there was previous resistance, and if that breaks, then I think we'll see some further support between $4 and $3.90 for round number support. I don't think we're going to these lower $3 levels again unless coronavirus strikes GameStops across the country, but that's probably not going to happen because no one actually goes to GameStop, and thus there are no customers that can get the disease. The obvious answer here is to buy puts at the $5 strike or do a 450 by $5 call credit spread, but I'm going to try something a little bit different. I'm going to try to catch the falling knife by wheeling GameStop with a basis below 450. And I'm actually okay with getting assigned there because I think GameStop will bounce between 4 and 450 for a while, so that will give me time to poach some premiums and bail at a profit. But on the technical end, I'm giving this a 2 out of 10 chance at working. I mostly want to do it because I think I can bring my basis to below $0 this year, which would be really hot. But since this is obviously a high-risk trade, I need to also do fundamental analysis. So I actually went to GameStop in my neighborhood to scope it out and took a picture of the scene while trying to be subtle. Here's me undercover with my cool guy hat, and you can see in the photo 3 customers, and there was actually a 4th behind my head that you can't see. And just to confirm my due diligence, I went back again the next day to see if more customers were present, and ignoring my big head in the picture, you can actually see here that there was another customer in the store, and if GameStop is still cool, then I am a put seller. So riding that fundamental analysis wave here on Tuesday, January 14th, let's open up GameStop, ticker GME. I think 450 is our short-term support, so I will sell a put at the $4.50 strike expiring next week to collect $16 premium. If assigned, my basis for the wheel will be $4.36, which I'm fine with right now. And if GameStop shows legs today and maybe wants to fill that gap after all, I might sell another. So let's lock this trade in, and off we go. And here we are an hour and a half later. GameStop is in fact showing some drive, so I'll sell another $4.50 put expiring this Friday, a week earlier than my other sell order, and this time just for $7 premium. This one, I hope it does not get me assigned, because my basis would be $4.43, which is a little high for my personal risk tolerance. Nevertheless, I'm feeling good about staying above $4.50 this week, so let's submit our order. While GameStop does its thing, let's check out another play of mine this episode. Aimmune Therapeutics, ticker AIMT. Matthew from Missouri sent me a $25 gift card to Olive Garden and requested a trade on AIMT because of a big FDA decision regarding its Palforzia peanut allergy treatment. So thank you, Matt, for the Olive Garden gift card. Here's me enjoying some spicy sausage and breadsticks, Mandy across the table ordered some chicken pasta, and baby Becky spent the entire meal having the freshest thing on the menu. Smart baby. For those not familiar, an FDA decision means that the Food and Drug Administration is deciding whether or not they'll let a company sell their drugs in the US. Unfortunately, I don't play biostocks very often since these FDA decisions are treated like binary events. Obviously, if they say no, that crushes the company and the stock. That means the FDA decision is basically the only driver that matters while that decision is pending. For that reason, fundamental analysis is much more important than technical analysis for FDA plays. According to pundits across the internet, the FDA is almost certain to approve Palforzia. I wanted to confirm that market sentiment by checking StockTwits, who are like Wall Street Bets autists times 2. StockTwits has a bunch of really dumb people pretending to be smart. At least on Wall Street Bets, we are proud of being degenerates. StockTwits has an older generation that pretends its FDs are actually high probability trades. But anyway, the clowns at StockTwits are extremely bullish, so I think this is a good indicator the price will tank. And paired with AIMT's recent price rise, I think the approval is already priced in. My temptation is to do an out-of-the-money call credit spread to inverse StockTwits, but at the same time, I must admit to myself that I don't know much about FDA plays, so I'm going to inverse myself inversing StockTwits. And if we apply some calculus, that means I'm actually going long AIMT. But what I need here is an option that does 3 things. 1, it won't expire. 2, the delta is close to 1. And 3, it's highly liquid. An option that does those 3 things is called a share. These are new concepts to Wall Street Bets, but bear with me. I went in on 10 shares with the goal of making 10% gain so that I could sell 9 shares and keep the 1 free share. With these shares on lock, we're going to await the FDA decision at the end of the month. While GME and AIMT do their science, I'm playing a handful of very high probability spreads just to bolster my portfolio. Here's Apple, on which I did 2 10% out of the money call credit spreads to pull just $7, looking for that gas money. here's Luckin Coffee for $20, and here's a Visa credit spread for $12. And this Visa trade gives us the opportunity to explore the first concept I want to address, and that is the post-earnings spread. When a stock moves dramatically after earnings, I've noticed that the stock almost never moves back past its pre-earnings price in the week following. Thus, it is a good time to sell credit spreads at that price. For example, on January 30th, Visa announced earnings in line with analyst expectations, but below what the market priced in. You can see here that Visa dropped from its pre-earnings price of $208. I took that opportunity to sell a call credit spread with the short strike just above the pre-earnings price. And although it did bounce back some from its low, we were well below the pre-earnings price when this option expired. Likewise, if Visa had risen after earnings, we'd sell a put credit spread at the pre-earnings price. The market is unlikely to reverse its consensus right after it's done reacting to earnings, so we take advantage of the post-earnings spread to get this very high probability money. Now let's back up a little bit before we get into concept number 2. What happened to my GameStop play? Well, unfortunately I did get assigned on the initial trade. GameStop traded at $4.32 on expiration, so I was assigned 100 shares at the $4.50 strike. Minus the $16 plus $7 I collected in premium, my $4.50 basis on entry was reduced to $4.27. I'm actually still profitable on this trade right now. And now that I'm assigned, it's time to start wheeling. So we are going to sell covered calls. Over the next several weeks, I sold covered calls to pull an additional $37 in premium. So as of this writing, my basis is $3.90 per share on GameStop. I'm still in the hole, but if I keep this up, I will come out on top. This gives us the chance to explore concept number 2 I want to address, and that is the price point touch, or PP touch. I've mentioned it before during the wheel video that we want to sell covered calls above our basis. So if my basis is $3.90 on GameStop, we don't want to sell below the $4 strike. But what if I could sell a call below my basis and collect enough premium to bring my basis down below that strike? For example, if my basis is $3.90 on GameStop, well, would I be wrong to sell the $3.50 strike if I could collect $44 in premium? That would bring my basis down to $3.46, so I'd be profitable even if assigned at $3.50 strike. This concept of selling at a strike below your basis to collect enough premium to cover the difference is what I call a price point touch, or PP touch. There is almost always a PP touch available if you are willing to be patient and sell long dated strikes. Let's continue with the GameStop example. At the time of this recording, GameStop is trading for $3.39 among the coronavirus crash. That is 50 cents below my basis at $3.90. But if I am willing to wait until October, I can get a PP touch by selling the $3 call for $97 in premium. That would bring my basis down to $2.93, so I would be profitable even if assigned. And if I were not that patient, I could sell the April $3.50 strike for $37 in premium, which would bring my basis down to $3.53 and leave me just $3 short of a PP touch. That's not bad for having been assigned shares a full 26% above the stock's current value. While I tangled with GameStop and am still mulling about for that PP touch, I also wheeled US Steel, which has not gone as well. I wanted to wheel US Steel because I believed that the tariffs would raise prices on steel and give the company a better margin. However, it turns out I was wrong, and I got assigned at the $10.50 strike. I had collected $23 in premium, so that brought my basis down to $10.27 per share. Over the next few weeks, I sold covered calls, spinning that wheel, and brought my basis down to $9.98. However, the coronavirus crash is currently on, and the US Steel stock is trading for just $7.87. That's $2.11 below my basis. I'd have to sell a covered call all the way out in January of next year at the $8 strike for $185 in premium, and I'd still be $4 short of a PP touch. That's like getting friend-zoned. My plan for this is to reduce my basis with higher strikes and then look for a PP touch later while the price recovers. I probably won't make much profit here, but eventually I will get my steel welded back together. Again, that was the price point touch, or PP touch, that we just discussed within the context of wheel strategies. We've been awaiting that FDA decision on AIMT, and that day finally came on January 31st. The FDA approved Palforzia as expected, but here's the problem. AIMT did not see that huge post-FDA run-up the guys on StockTwits were expecting. The stock did rise after market, so I sold 9 of the 10 shares at $37.50, which was $3.02 higher than I bought it. That was the first time I ever sold shares after market hours, so good on Robinhood for making that possible. I told Matt what I was doing, but he was busy buying calls on Space and literally did not give a fuck about AIMT. When AIMT opened, you can see that it never got close to that $37.50 after hours price, and in fact hasn't done much since, so good exit on my part. All in all, I had bought 10 shares for $344.75 and sold 9 of them for $337.50. That left me with 1 share of AIMT with a basis of $7.25. As long as AIMT stays above $7.25, I will have profited, and that 1 share of AIMT will stay a permanent part of my portfolio. Combined with free breadsticks, this is a win. And then things got crazy. It's time for coronavirus. The Kung Flu came through like a PO'd Hong Kong phooey, cold clocking the Dow back to its levels first seen in January 2018. 2 years of gains were wiped out in one devastating week. The Discord voice channel was filled with inane banter as Theta Gang members flipped bearish.
Dude, I don't know why I care.
It's the past $300.
Holy shit.
It's sub $300.
As for me, I saw a couple opportunities to quickly flip some bearish plays for profit, but it was just ice on the wound. First, I entered a put debit spread on QQQ, which is the NASDAQ version of SPY. I owe you guys a video on debit spreads, but for the purposes of this video, know that it is a limited risk bearish play. We start by buying a put, I'll select the 223 strike, and then sell another. This is at the 222.50 strike to reduce my cost while capping my gain. This will cost me $19, and the max gain is $31. We'll go more into this in a strategy video, but I bought to open the debit spread right about here, literally the very bottom, for $19. And then I started getting scared when Triple Q bounced up. But a little while later, Triple Q dropped back down and my bearish spread netted me $31 for a $12 gain. And then things got even more interesting when I got lucky. No fewer than 5 people used my referral links this month, giving me free stocks. Usually when that happens, Robinhood gives me some trash company like my Dixafloppin Pharmaceuticals trading at $3.21. And for the first 4, that's what happened. I got like $14 worth of junk companies that I just sold for cash. But that 5th stock, awarded to me when some wonderful woman named Michelle used my referral link, was something much better: Microsoft. That's a free $170 worth of referral stock. If you're superstitious, I got Microsoft when I hit the skip button instead of scratching out the share. I'm 100% sure that has nothing to do with it, but I know one of you is now going to start hitting the skip button every time. Now, getting a $4 share of Dickdown LLC isn't consequential to this challenge, but a $170 share of Microsoft is huge. So I want you guys to vote in this poll. When I get a stock like that, should I keep it, should I sell it and do spreads, or should I sell it and YOLO the money? You guys vote in the poll and tell me, but I'm not going to pretend that I don't know how that poll is going to end up. So let's go ahead and just YOLO this. I'm obviously very bearish right now, so I bought a QQQ put at the 216 price for $271, and I felt great about the trade. But no more than a few minutes later, someone in the frat house showed us the Fed's commitment to keeping markets from crashing by injecting billions of dollars into the repo market. Now, I don't really know what that means for stocks, but it doesn't sound good for bears. So you know what? This just isn't me. I bailed and sold the put for $300, netting a $29 gain. That put me at $41 gain for my Triple Q plays, plus I flipped Triple Q and SPY later until I hit the pattern day trade, putting me at a $51 gain for these trades. Among this crash, I'm also opening a wheel trade on Snap because I want to own it at 15. I like the premiums, and I think they will eventually get bought out. But do you guys remember that iron butterfly I opened in the last instructional video? Well, I got assigned on the short leg, which forced me to buy 100 shares of SPY for $32,500. And unfortunately, that put me in margin call. Now, of course, I bought the SPY 324 put as the other leg of that butterfly, so I can just execute that, sell the shares for $32,400, and after accounting for the $96 in premium I collected on that, that makes my loss just $4. However, what I love about Robinhood is that they don't have a phone number, so to execute my put, I have to email Brittany from accounting, who will respond in 1 to 3 business days. That long put will satisfy my margin call with no problem. It's just a $4 loss even though it looks scary. But until Brittany executes for me, I have negative $63,000 of buying power. You'd think Robinhood would figure out that when we open spreads, we have the plan of actually executing the long leg when we get assigned on the short end. But Robinhood just isn't sophisticated enough to know that we don't want to buy 34 grand worth of shares in our $3,000 accounts. Overall, the option settled with no problem, the margin call was satisfied when I executed the 325 SPY put, and I actually recovered toward the end of the week. My goal was to reach $3,500 this episode, and while I did get there, I can't take credit for about $187 of this move because of the 5 referral shares, including the big Microsoft one. Subtracting those out, I actually lost $7 this episode. I guess coming close to break even is not too bad considering the Dow tanked 3,000 points last week, but it's still frustrating to have lost all that time. If I hadn't bought Triple Q at the very top, my portfolio would be looking a lot better right now. And as we wrap this up, I have a big announcement. The next episode is the Season 1 finale. It's time to YOLO my gains and make this a season premiere to remember. Next episode, we go in guns blazing so we can kick off Season 2 with some solid momentum. Hang tight everyone, we'll get through this chaos and let loose the tendies. Thanks for watching everyone, best of luck over the coming weeks. Stay safe out there, wash your hands, and don't let the corona get you. See you next time for the Season 1 finale.